Yes. So we are into risk management. That basically it's more of P3 risk related subject, but in the recent syllabus, as I told, they have put into financial strategy. So this section, chapter 8, 9, and 10, yesterday we covered 8 and 9. Here they are talking about the risk companies are facing. Mostly they are coming from financial risk. What currency risk will face, what economic risk will face, and all of that. Okay. So today we'll start with the interest rate risk. So firstly, what is interest rate? In simple terms, if we say interest rate is the amount of money you have to pay the bank apart from the principal amount. And obviously, this is the profit for the bank. Banks are working for this only. As a business, we need to have finance. And where we get finance from, sometimes we take from shareholders. But it's not possible to take money always from the shareholders. Once they buy the share, they invest into the company. But you cannot depend every time for the shareholders. So we go to the lenders. The lenders are like banks. They give us loans. Okay. So there are different companies. They will have different interest rate. Different banks charge different interest rate. Ideally, for our company, we should try to get the best interest rate, and we'll try to manage it. Why interest rate risk is important? Imagine the market rate is going on 9%. You have taken $1 million and you lock up for 9.5%. Even that 5% will cost a lot for the business, because usually these loans are for long term, 5 years, 10 years, 15 years. So over the period of time, it can be a huge cash outflow for the business. So managing interest rate is of key importance. If you compare this to currency movements are very, very often. Okay. But the impact is not that high because it will affect certain transactions. But interest rate is like you get lock up for a very, very long period. Therefore, companies try to have mix of floating rate, fixed rate, and how to manage that we'll see here. Okay. Another reason why we go for loan is we get tax benefit. Interest is tax deductible. So it is also promising for the companies to use debt. However, using debt to a certain options, certain position. After that, let's say we have a gearing more than 50%. So more than 50% of gearing can be problematic for the business, can be more risky for the business. We have seen for our company now, for August case study, it's a logistic business. What is our gearing? It is around 39 to 40%. So still decent. But imagine if it goes to 59%, even coming to 50% exactly, then going for debt can be more risky. Okay, so we have to see the key ratios, we have to see the stakeholders. The difference in case study and individual paper is, now if you're talking about F3, financial perspective, it's like giving an holistic view to your answers. Okay. So before starting, we'll just quickly see some of the terminologies. Lending and depositing rates. So as a business or individual, we not only lend to the, not only lend from the business, sometimes we deposits also, right? So we get interest. A bank will quote two interest rate, lending rate and depositing rate. Lending rate is always higher than the deposit rate. Obviously, why? Because the bank wants to make profit. If you put a FD, you might get 5%, 6%. And if you take a loan, you might have to pay 8%, 9%, 12%, depending on what type of loan they have taken. Same thing work for the businesses. Then we have LIBOR, London Interbank Offer Rate. So basically, this is a base rate based on which the major banks can borrow. Sometimes it can be very important when we are doing the flexible rate, or we can say floating rate interest. In that, this LIBOR will be keep changing and the amount on the top will be fixed. For example, LIBOR is 5% and on the top it is 2.5% you have to pay. Tomorrow LIBOR becomes 5.5, so interest rate will become 8% compared to the previous 7.5. Next is LIBID, London Interbank bid rate. It is a rate of interest that a top rated London bank could obtain on short term wholesale deposit with another bank. So mostly it is bank to bank transactions. This is not very important for us. Even this terminology is just for understanding. They won't ask directly in the exam. Then term structure of interest rates. What structure we have done? How we'll pay? Is there any chance to reduce the interest, or how much flexibility we have? Term and structures we can negotiate. Next terminology is yield curve. It is related to the previous one only. The term structure of interest rate. It is a relationship between interest rate or bond yields and different terms of maturities. It is also known as yield curve. Yield is basically the returns, how much returns it is getting. Higher yield means higher interest rates. So when we want to do the risk management, we have two options. One is internal, one is external. So obviously, first priority for our business should be what? To done internally. Why? Because if you do internally, you can save cost, isn't it? So what are the options we have for internal risk management? Interest rate risk management. We have two options to take loan. Just to go to the basics again, when we are taking loan, we can select interest rate which is fixed, let's say 8% flat or 9% flat, or other options can be, we can say floating, which can be LIBOR plus 5, LIBOR plus 3%, LIBOR plus 2%. LIBOR keeps on changing, then interest rate also keeps on changing. Okay, they have given some this management here, but I just want to know all of your views. What do you think will be good for businesses, to go for fixed rate of interest or floating rate of interest? You can give example rate to our industry also, logistics, that will be even better. Just say which one you prefer and why. What is your understanding so far, whatever knowledge you have?
I think, for instance, if it was the COVID time, it would have been better if we went for a fixed interest. But for now, I think since interest rates are already high, variable would be better. Interest rate would go down in the future.
Very good point. Okay, I'll just add a small question to that.
Mhm.
Also mention in your answer, will it be like mid-term, short-term, which loan you're talking about, or long-term or short-term, you can divide.
Mm.
I mean, your answer will be same if it is for short-term or long-term, Nikhil.
It would be same actually.
For
Just let
long-term
me
also
think
you
though.
want to go in floating?
Um, for instance, the rates here were like 1%, 2% in COVID times. So that for that time you can take a long term loan. For now, even if it's long term, I think only variable is better.
Why? Why it is better?
Because the interest rate currently are very high and it's expected that it will go down in the upcoming months and years.
Okay. You can even discuss about the type of business we are, what type of cash flows we are having in collaterals. Lot of things need to be looked at.
Mhm.
Okay. Others?
I
Waqar?
think, yeah, I think even for me in a short term, if it is so when I say short term means within, let's say, 1 year, right? And long term is like more than 1 year. So short term, I guess fixed is okay, and long term, I think floating rate is better. But here we are taking an assumption that round land is a very stable economy. They don't have any instability in terms of political instability and others. So I think for us, like, the floating one is more preferable in a longer run.
Right. Others? Jitu, Shweta?
I don't have much points.
Just normal. You can even say, I feel like
Yeah,
it should be both. Whatever you feel like. Be
I mean,
confident.
yeah, I'm goes with the Waka's opinion. Um,
Can you repeat his
yes,
opinion?
I mean, the floating rate is best for long time, and the fixed is uh, for the short time borrowings.
Okay. Fixed for short-term borrowing.
Yeah.
Could you please repeat that point about short term and how the, I mean, short term and long term?
Vakar, can you explain your point again? Why you say that?
So I'm saying that I was saying that short term is like within, let's say, 1 year, right? It's a short term period
1
because
to 2 years.
definitely we cannot foresee a very long term situation what's going to happen, but we know sitting today how things are going to be in a year's time, right? So I think if we are taking a short term loan to refinance some projects or to meet the cash flow position and all, fixed is better. But if it is a long term position, let's say 5 years, 10 years, 15 years from now on, we already know the environment is inflationary environment right now, and because of the growing inflation, there is a increase in interest rate from the central banks across the globe. So the interest rate might come down, right? So I think for a long term strategy, I would say that we need to go for a floating interest rate.
Sounds valid point. Yeah. Shweta, you want to add something?
I was just wondering, due to the unpredictability about the future, wouldn't fixed rates be less risky in the long term?
Yes, that's a good point. But there is one catch we need to understand. Imagine you locked up with 9% fixed interest rate, and suddenly uh, the economic situation improves, or government policies are pushing businesses, and they reduce the interest rate. Okay, from 9% it went down to 8%. And let's say your competitor is getting interest rate at 8% and you're paying 9% every year. It's say 10 million, 20 million. It's a very big amount. You can imagine how much extra cash you have to pay, right? And what if your competitor use the same thing and pass it on to the customer? So they can get a competitive advantage over you. So that's a big risk. And it's not only for the short term, let's say it's for 10 years. So 10 years we are stuck. We have to pay extra money all the time.
And one more thing is that I don't think that fixed rate is equivalent to the even the floating base rate. The floating base rate is always lesser than the fixed rate because banks also wants to make money. So the fixed rate which bank offers is definitely higher than the base floating rate, which is basically LIBOR, KIBOR, or whatever, right? Wherever the country is based in.
Right. But we have advantages also having fixed rate. Recently in Poland, I think they have increased the interest rate after 30 years, around 30 years. So companies who are into fixed rate, they are still happy because it's very, very rare they are changing the interest rate. It was in Poland or Italy somewhere. And people who are in flexible now, they're struggling. So both will have its upside and downside. So usually companies are not looking to gain from here. They are like, we don't have to lose from here. Okay. So when you don't want to lose, you can play a safer game. What is a safer game? You can have mix of both, floating and fixed. So if you're gaining from here, you might have to give away the other way. And if you're gaining from other side, you have to give away this way. Okay. So internal hedging, if you see first risk management strategy is that only smoothing. The company tries to maintain a certain balance between its fixed rate and floating rate borrowing. The portfolio is fixed and floating rate debts thus provide natural hedge. What is the meaning of hedging? Hedging is nothing but kind of financial risk management. You're just managing it, managing your currency, managing your financial issues. That is hedging. Changes in interest rate. There will be less exposure to the adverse effects of each, but there will also be less exposure to favorable movements in the interest rate. You are not gaining also, you are not losing also. Internally, and you don't have to hire any expert or pay to the financial institution for this hedging. For example, when we'll see external hedging next part, you have to spend money. Nothing is free there, but here it's free. It's just your strategy. Okay. Next option we have for internal hedging is matching. The company matches its asset and liabilities to have a common interest rate. That is, your loan and investment both have floating rates, asset and liabilities. So the net effect should be almost zero.
Hello. Misbah, can you repeat? I think your internet had some interruption.
Okay. I was saying matching is about having our assets and liabilities into the same thing. For example, we are getting some interest from an FDs and all. Then we have to pay some interest. Both will do into the same thing. So ultimately, same effect. It will become net zero.
Okay.
Same thing we do into currency also. Am I audible?
Yes.
Hello? I can't hear you.
Hello, can you hear me now?
Yeah, there was a long pause on this.
No, I was on mute. I just joined from other device to make it more clear. Yeah.
Okay.
So matching is okay with you guys? Matching is having assets and liabilities into the same interest rate. So what we are paying and what we are receiving in the same. If it is fixed, then you pay into fixed and receive into fixed. If it is floating, you pay into fixed and receive also in floating. Ultimately, the effect will be net zero. Almost zero. We cannot say will not have any loss or gain, maybe very minute. Then we have netting. The company aggregates all positions, both assets and liabilities, to determine its net exposure. So your company will try to see overall how much it is. They won't go with matching as fixed, but overall they try to see what is the net exposure. For example, if this floating rate changes, how much we'll lose. If fixed rate changes, how much we can gain or loss. Again, either way. Based on the net exposure, they will decide, is it worth taking the risk or not. That is netting. Okay. Very similar to currency. But in currency, we can do one more option of internal hedging. What is that? In fact, two more. If you remember, first thing you can take CIMA example only. You can ask others to invoice in your local currency. Like whichever part of you are there in the world, you have to pay in pounds. Second is kind of barter system. Instead of giving them money, we can give them a service or product in return. That is in the currency internal hedging we have seen. So companies have their treasury department who looks into it and they do a detailed analysis. Okay, now we'll do external hedging. So when we talk about external hedging, the primary disadvantage of this is you have to pay for it. It is expensive. Whatever we are choosing, we have a lot of options, but everything will be costing us. Everything is costly. We can just decide which one is worth it with the cost and benefit analysis. So here we can do forward rate agreements. We can go for interest rate guarantees, interest rate futures, interest rate options. We'll see all of this in detail. However, when we talk about risk management, mostly we are not looking at any upside potential. Upside potential is like, can we make profit out of it? Can we gain from it? Mostly we don't want to lose anything. We want our cash flows to be predictable. We want our working capital to be taken care of. Okay. However, there is one option where they can have upside potential. We'll see. First is forward rate agreement. In short, we call it FRA. Yeah. One more thing I want to make it clear for your exams is they won't ask you in detail how these forward rate agreements work, how this hedging works. Usually in CIMA, I have seen this question will come, what are the internal or external hedging methods we have, or currency risk management options we have, or interest rate risk management options we have. So you can name some of them and explain it according to the scenario. That's it. Nothing more than that. The reason being why they don't go in detail is because these topics are already tested in detail when students write individual papers. So it doesn't make sense to, test that in detail again. So forward rate agreement on FRA. It is a forward contract on an interest rate for future short-term loan or deposit. Can be done for the loan also and deposit also. Because for deposit also we can lose, isn't it? When we talk about agreement, right, forward rate. So maybe it is same as the current rate what we have, or it can be little bit different in the future. But whatever it is, it should be fixed. Okay. FRA can therefore use to fix the interest rate. Maybe today's interest rate is 9. You are working with that in financial institution, you fix for 9.5. No problem. Or you fix today is also 9. You fix for 9. That's also fine. But whatever you want, just fix it today for the future date. It doesn't matter what is the external environment, what is the economic situation, what policies are coming in. An important feature of an FRA is that the agreement is independent of the loan or deposit itself. They can even decide on the loan, but this thing will be fixed. It is about the rate of interest on a notional amount of principal starting at a future date. Now you must be thinking, if let's say we agreed on 9%, okay, and when it went that time it became 10% or 12%. Let's say in the worst case 3% difference. So we are getting a deal for 9. Then how bank will survive? So if you think from bank's perspective, banks are very clever. They always make money. They will also diversify their portfolio. They'll also have half in fixed, half in floating rate. So technically they don't lose. They have also made it equal. Okay. Then FRA does not replace taking out the loan, but rather the combination of the loan. And FRA result in fixed effective interest rate. FRA notional 3-month loan deposit starting in 5 months time is called 5 to 8. These are technicalities. They just say 5-8 means it will start after 5 months to 8. So 3 months kind of thing. Then settlements. How to do the settlement? Again, they won't ask this just for understanding. If the fixed rate in the agreement is higher than the reference rate, the buyer of FRA makes a cash payment to the seller. The payment is for the amount by which FRA rate exceeds the reference rate. So whatever there is a difference. Or if it is lower, then the seller of FRA makes a cash payment to the buyer. So basically you have done the contract. If there is any changes, you'll get the difference. So there is no loss in that. Clear? So first option is forward rate guarantee. Yeah, one more thing I just want to make it clear in the 2x2 model. If you go up again, we have discussed this forward rate agreements. Okay, one second, I'll share. So basically, forward rate agreement, the advantage is it is tailor-made. Tailor-made means you can decide what you want according to your need. So in this 2x2 model, if you see on the screen, over the counter OTC or tailor products. That means it will be fixed according to the need of the business. Forward agreement also, interest rate guarantees also. It's kind of insurance instrument also we call. The other two which we'll see will be standard. You just have to buy which is available in the market. Interest rate guarantees, the second one. It is also tailor-made. Interest rate guarantees are options on FRAs, so the treasury has the choice whether to exercise or not. They are over the counter. Over the counter means what? It is a tailor-made. A company wishing to borrow in the future could hedge by buying an FRA, so would need an IRG that provides a call option. Call option means to buy it. Okay. A company wishing to deposit in the future could hedge by selling an FRA, so would have a put option. Put option means to sell. The company would only exercise the option to protect against an adverse interest rate movements. Obviously, they'll use if they are about to lose or about to have something which is unfavorable. If there's an adverse movement, they'll use it. If there is favorable, they won't use it. Why? Because they'll get the advantage. Now we'll go to exchange interest rate futures. Number 3 options of external hedging. IRFs. IRFs are similar in principle to forward rate agreements, FRA, in that they give a commitment. What is the difference? But they are tradable contracts and operate and circulate. The difference is this is standard. Whatever is available in the market, you have to buy it. You cannot decide on your own. Let's say if it is terminating on every 3 months, so you have to do it like that only. The future is priced by taking the interest rate from 100. How they put is like, they won't say 5%, they will say 95%. 95% means 5% interest rate. If they say 92%, 92% means 8% interest rate. So this is just a way of writing. You don't need to worry about it because that is more important calculation. Gain and losses. The STIRs are calculated by reference on the interest rate at the date of closeout. The difference between the future price at inception and close will be gain or loss. Next is option. So as the name suggests, options, that means it is a right. If you want to use it, use it. If you don't want to use it, you cannot. Just like forwarded agreement, it's not a compulsion. So whenever there is an option, that means there can be upside potential. What can be the upside potential? Let's say you are paying now 8% fixed interest rate. Now in the market, it became 7%. So you'll utilize it and come down to 7. And let's say if it is 8 and market it becomes 9. So you won't use it. Why? Because you might have to pay extra. So when we are doing this type of risk management, obviously you have to pay extra money for it. It's a premium. Okay. And just see what it's talking about. This option gives its buyer the right to buy or sell an interest rate future at a specified future date at a fixed exercise rate. So it will give right. When they say the word right, that means it's not compulsion. You can choose it or not. Because they are an option as opposed to commitment, they require the option holder to pay the writer a premium. How they can buy it is they have to pay extra price. Other contracts will also be expensive, but this will be a premium pricing. Why premium pricing? Because of the upside potential. So obviously companies choosing this option means they are hoping that there will be more fluctuation in the market and they want to get benefit out of it and they don't want to lose out. They can be fixed the interest amount or can be allowed to lapse to take advantage of favorable movement in interest rate. Usually this is given for 6 months. I mean given interest rate, example 6 months enough. Call option means to buy and put option means to sell. Then they are talking about callers. You can ignore. Next is swapping. Swapping is also a very good option for managing interest rate. What we can do is we can two parties. Let's say company. Now we have company a Daistruk and we have another company. Let's say both are in different countries. Now we go to Eastland. There we need to take a loan in Eastland, but the local bank is giving us more interest. And we have an Eastlandian company who's coming in Groundland. They also are getting extra interest rate because it's an international company. So both of us can swap the interest rate. So it will be beneficial for both the companies. Obviously, we cannot swap the principal, but the interest rate. Even it can be used to change the currency, obviously. Like round line to east line I gave. Here they are talking about euro to GBP. An interest rate swap is an agreement whereby two parties agree to swap a floating system of interest payment. Sometimes that swap can be with the help of bank from floating to fix, floating to fix, floating to floating also it can be, fixed to fix also, and floating to fix. And obviously for that again bank will charge the money. Interest rate hedge used by companies because they can hedge borrowings of anywhere between a year and 30 years and therefore can be used for long-term borrowing. Bank act as swap counterparty. Usually you have to do it with the banks. Okay. I'll show you one question on this, or maybe I'll share with you. So you'll have an idea. If some of you is getting under confidence, you know how these things will be answered. It's a little bit messy. There are so many things and information given here. Once you see an exam kind of question or mock, things will become clear. Okay. Now you just see it as, okay, internally we have this option, externally we have that options. And these are the characteristics of individual options. Okay. You getting the point? Hello.
Yeah.
Okay.
Yeah.
They have given the calculations also, not required for case study, but quickly I'll say what happens, you know, when you go to fixed to floating or floating to fixed. So there is one LIBOR rate. LIBOR rate also keeps on changing. So you just have to see what is the difference. Sometime if you are moving fixed to floating, we have to pay extra money. How much we need to pay? That is the difference we calculate. Okay. What is the advantage, disadvantage? We can quickly have a look. To manage fixed and floating rate debt profiles without having to change the borrowing. Let's say we are stuck in fixed. Now we can change to floating. To hedge against variations in interest on floating rate debt, or conversely on the fixed also. And ultimately, why we are doing it? Because we want to save the money to find a cheaper finance, isn't it? What can be the disadvantages? Interest rate may change in the future and the company might be locked into an unfavorable rate. Let's say you move from one to another, then again we are locked into unfavorable. Previous one was good. Then credit worthiness of the bank. How much you can trust the bank, how much they are charging, all of that. Same thing can work in cross-currency swap also. So a cross-currency swap allows a company to swap a currency it currently holds for different currencies for a fixed period. Then again, it can be swapped back at the end of the period. Again, you'll do with the help of bank, and bank will be charging every time. In case of cross currency, we have two elements important. One is that principals, if you are doing it, will be done at the spot rate, spot currency rate. Interest, the timing of this depends on individual contract. You know, sometimes this can be different from actually what's happening in the market. It all depends on the market. It can be fixed also, floating also. Advantages of this, if you see, currency profile may help reduce interest cost. So how this can be used for our case? Let's say Daistruk need money in Eastland. So we can say, if you are not getting, why can't we use currency swap? Take your loan there, then use a currency swap like that. It's a part of broader strategy of risk management or currency risk management. Disadvantage, what if the other party defaults? What if the bank itself goes out of business? And normal disadvantage here is it's a costly affair because banks will have a charging, right? And also you need experts to be coming in for that. Okay. Any question? Hello.
No.
Yeah. So what is the takeaway for you for case studies? Interest rate risk management, you should know the internal methods and external methods and some characteristics of it. Okay. Now we'll move to the next section. I'll send you one question so you can get an idea also. Next is about the business valuations and mergers acquisition. Very important. This last section is 7, 12, and 13. It's very, very important. It has been always tested. Okay. Am I audible?
Yes,
Yes.
yes, we can hear.
Okay. So financial and strategic implication of mergers and acquisition. So firstly, what is mergers and acquisition? What is M&A? Can you guys quickly tell what it is?
Merger
Hello.
would be just like two companies becoming A plus B, and acquisition will be like A takes over completely B, or vice versa.
Okay. Just give the example in terms of Daistruk.
Like Jaguar and Land Rover merger.
Jaguar and Land Rover had a
Yeah.
merger. Good example.
HDFC Home Loans and HDFC Bank, like they are merged recently.
Right, HDFC example. We can, if you talk about these industries, we have this Vodafone and Idea also merged together. They
Yeah,
become
yeah,
PI.
yeah.
And examples of acquisition.
I don't have any idea acquiring any company.
Others. This is very, very important topic, and daily lots of mergers and acquisitions are happening. If you know from the industry, that will be great. But general also you can talk about. Facebook acquired WhatsApp. It is one of the famous acquisition.
Yeah,
Usually bigger.
Tesla
Yeah.
acquired Twitter, for example. That is another acquisition. So they paid $44 billion, right? They acquired Twitter.
Yes. Usually bigger companies, what they do, they acquire smaller companies directly because they know if you don't do that in 5 years, 10 years down the line, these people will be our competitors. So buying them just to, kill them, kill the competition. That's the plan. They're ready to pay multiple number or multiple times in their valuation because they don't want anybody to come close. This can be argued of being unethical also, but this is how it is work. Right? So mergers and acquisition is very important topic for us. In almost all the exams, this topic has been tested. And I believe it will be same for August exam, November and February, whatever you are writing. So usually M&A, they talk it together only. Even in the textbook, they have mentioned all the characteristics they are talking about is similar to M&A. Why? Because if A acquires B, they become A. B loses its all identity. When A and B comes together, it's a merger, it becomes AB company. However, in the both the scenario, they become one team, isn't it? Therefore, most of the things are similar to that. The theory, if I just quickly go through, is the joining together of two or more entities. If one entity acquires a majority shareholding in another, the second is said to have been acquired by the first. If the two entities join together to submerge their separate identities into a new entity, the process described as merger. Okay. Now we have types of M&A. It can be horizontal, vertical, and conglomerate. Let's talk about acquisition. Same applies for merger. Horizontal means we have a logistic company, not Daistruk. We have a competitor named Carry, or we have practical world. If you talk about, we have DHL, UPS. Let's say we acquire DHL. So what types of acquisition it will be? It will be horizontal acquisition. That means we are acquired a company at our level. For example, one wholesaler acquire another wholesaler. One retailer acquire another retailer. Let's say tomorrow Apple acquired Samsung, or Samsung acquired Apple. So it will be a horizontal acquisition. Next is vertical. Verticals is subdivided into two: vertical forward, vertical backward. Vertical backward means our suppliers. Let's say a wholesaler acquire a manufacturer. So it will be a vertical backward acquisition. Now same wholesaler acquired some retailer. So it will be vertical forward. From not at same level, but from our supply chain, we have been acquiring somebody from backward integration or forward integration. That is a vertical acquisition. Then it's a conglomerate. So conglomerate is something that when you go outside the industry, new product, new industry. Now we are into logistics. Now tomorrow we said let's go and manufacture electronics, and for that we are acquiring certain business. That becomes a conglomerate. Okay. Can you guys give an example of horizontal, vertical, and conglomerate for our company? We are a logistic company. Okay. Just to clarify for Harish and Shweta, we are a logistic company, and we do almost all types of logistics. And we have like one of the leader in the country. You can just think of it like a DHL. We are a listed and very big company. So what kind of horizontal acquisition we can do and why? What kind of vertical we can do and why? And conglomerate, same. If you want, you can just see the reasons also. So it can help you in answering why. First is it can help in increasing market share. Currently we have, let's say 15%, then we can become 25%. And with market share, technically you'll get more powerful. However, we need to be careful. When we get more than 25% market share, the competition authorities won't allow us. Like in the UK, it is said more than 25%, or when it's 25 to 30%, it's come as monopoly. So competition authorities won't allow us. Second reason is economies of scale, especially when you are doing horizontal. It can help you in economies of scale. Why? Because duplication will be removed. Next is combining complementary needs. Complementary needs, let's say one company has a very good amount of cash, very good cash balance. Another company has very good management skills, and both needs that. It's a complementary needs. Next is improving efficiency. Lot of time the protocols they are following, the systems they have, that can also help in improving efficiency. Nowadays, logistic companies like UPS is the best example. How they are using big data to be very efficient. The example I am referring to is how they use big data, and they have, make their drivers to use only right turns, because right is a free turn in the US. If they wait on signal, it might take more time. It's better to take a longer route rather than waiting for the signal at 2 minutes or 3 minutes sometime. So this is how they improve efficiency. Let's say we do a mergers and acquisition with a company which have this type of data, or they are using data analysis. It can improve efficiency, isn't it? And sometimes what happens, we have a good amount of cash and we don't see any good investment opportunities. So why can't we just buy off a company? So that is lack of profitable investment opportunities. Sometimes it can be a conglomerate also. We can just buy it off and we want the same management to continue. That can also be an investment. Another option is tax relief. This is also commonly used. We buy off a company directly, which is loss making. Why? Because as a group company, we can reduce the tax. You know, some people will argue. So what will happen? The primary reason is cash outflow will reduce. Simple as that. Later on, we'll see what benefit we can get. But once money gone out, means out. So tax relief. So purposely, they'll see a company which is making losses. Next, the most important reason why acquisition happens, especially bigger companies do, is reduce competition. That's what Facebook is doing. Reduce competition. Not now, but in the future. Even Google, if you see, every time they are buying, a lot of time it doesn't become public, but there are so many acquisition happening to reduce the competition, be relevant in the long term. Especially in the business where barriers to entry is less, or like in IT system, people can come up with disruption technology, disruptive business model. So best way is to what? Buy out. Okay. Next is asset stripping. If you feel like they have a very good asset, for example, in logistic business, we find a company which has a very good amount of fleet, they have good warehouses, but currently they are struggling for working capital, they have got a lot of debt, not able to sustain. So we are like, okay, let's acquire that company just to use their warehouses, use their fleet of vehicles, all of this. Last one is big data opportunities. This is a new reason, especially, we can say in last 5 to 10 years, why a lot of companies started acquisition only because of big data opportunities. Two attempts before, I have a student, they are working in a very big company, listed company in the UK. Okay. They are a marketing company. So they are saying 90% of their acquisition in last 3 years, they almost bought 40 to 45 companies, small to medium companies, all because of big data opportunities. Because if they have big data, they're able to reduce the cost. They'll make it more selective.
What is big data?
Big data is just the amount of data we have. For example, now let's talk about any training business. So they can know what type of courses will sell, how much pricing is done. Okay, I'll give you a better example. Talk about Zomato. Now, Zomato has a very good amount of data. Let's say you're opening a restaurant in Kochi. Okay. So Zomato will know in Kochi, Kerala, how many restaurants are there, what kind of pricing is successful, what kind of food people are liking. Okay. In which day, what time, let's say in lunchtime or dinner time, the sale will go up. In which area, what kind of food is more selling. Getting the point? So now if somebody wants to come up a new restaurant, Zomato have all the big data or data to give you. So your chances of success will be very high. This is just one example. Now you can
So
imagine.
basically, you're acquiring to get that key info.
Yes, Zomato is again very small. If you compare that with Google, what amount of data Google is holding, isn't it? And even what we talk about now, this application like Chat GPT, that is AI powered, right? It's using machine learning and everything. What is machine learning? How they are learning? It's all because of the data. They have been given a lot of data. Based on that, they are continuously learning. If you're doing any business and if you have got good amount of data, automatically your chances of success will multiply, isn't it? You will not do a lot of mistakes which other businesses have done. Got it? Hello? Shweta, are you okay now? Hello, am I audible? It says host turn off microphones. Okay. Try now.
Yeah, now I can.
Yeah.
Shweta, are you okay?
Yeah.
So this is the primary reason now, because data is the new currency. If I have data, means I can make all or at least 99%, 98% correct decisions, isn't it? We have even some extra reading here. Large, especially if you go with the big data definition, it's usually a very large amount of data. What I was giving you is data example. Big data can be even bigger thing. It's a very large amount of data collected from different sources, which is constantly updating. See, different sources can be social media, newspaper, uh, then it can be books, it can be magazine, it can be interviews, it can be podcast, it can be, so many sources. Large volume of data beyond the normal processing, storage, and analysis capacity of typical database application tools. Benefits: driving innovation by reducing time taken to answer key business. How these botnets work? Not botnets, but how these bots work. If you go to the website, even CIMA website have that. Nowadays, you don't need a customer service person, or you need very less person. Why? The chat bot will reply all of this. They'll send you the link because they know what are the frequently asked questions, right? Gain competitive advantage, improving productivity, relevance. The acquisition of a company with large database of customers would be an example of this that also incorporates big data. Access to this database and also the skills of target company staff who have collected and analyzed the big data. All our activity on internet has been, is being watched. Now they're analyzing it and trying to, what is data analysis? They're trying to convert this big data into something useful information. Okay. Clear with these points, guys? This strategic case
Yes.
study is very, very interesting. It's not very theoretical. It's all or mostly practical. Whatever we see in the real world, that reason we can add here. They have given 8-9 points here, but you can even add your points why we should do merger and acquisition. Reduce competition, we can say. One point we can add here is to enter a new market. Usually bigger companies, they don't want to start from scratch. What we called as organic development. They do it by acquiring another company because it saves a lot of time. There are a lot of other reasons also you can talk about. This Thomas Cook, what they did now in one of the example, they were not getting a landing slot at Heathrow Airport. So they acquired another airlines, which was a small loss-making company, just to get a landing slot in Heathrow Airport. It's very difficult to get there because a lot of people prefer transit through Heathrow Airport. So if you do that, we'll get higher sales. They acquired it. So there are so many reasons for doing that. Okay. So coming back to my question, you can just take 30 seconds or 1 minute to think. For a logistic company, what types of acquisition will be helpful or mergers will be helpful out of this horizontal vertical conglomerate, and what will be the reason for it? What will be helpful and why? Okay. All of you have to answer. And remember, there is no right and wrong answer in case study. It's just like more right or less right. Okay. It's about how you justify that makes sense. Ready? Yeah, let's start. Who will start, Wakhar or Nikhil? This kind of question you'll get in exam. So if you do this, you should be proud of yourself.
Yeah, I am goes with the conglomerate.
Okay, you can start. So I want complete
Mm,
answer, Jitu. Conglomerate, which conglomerate, how and why, advantage, disadvantage, all of this. Yeah, start please.
So at the moment, conglomerate help us to diversify the business, and it can help us to enter the new markets. At the moment, we don't have any other businesses in except around land. So it is the easiest way to enter into a new market. Mm,
So what kind of conglomerate? You cannot just say conglomerate. Which conglomerate you want to go?
mm, a data selling company, or
Sorry, which
a
company?
um, data consultancy service company, or
You're saying consultancy companies?
Yes.
Okay, why particular companies you are saying?
Mm, uh, mm,
Reasons.
because at least we have few knowledges about the data, because Daistruk have a good uh, information and technology system. So we already have a good knowledge about the data handling. So it will be a good for us to acquire or merge with the data consulting or data sourcing companies.
Okay. It's fine, but Jitu, when you're writing, no, so you should have
Mhm.
the answer ready in your mind. Now it's fine. You'll get more time also. That's very less. Whenever you're
Yeah.
starting your answer, you should plan in your mind how I will end also. That is very much key for SCS exams. Otherwise,
Ah,
we can have unfinished answers. Are getting the point?
mhm. Yes.
The bullets point should be ready. Okay.
Mhm.
Next.
I think I would go for a conglomerate because, and I would look for an industry which is a little bit more kind of recession free, because tomorrow if there is a pandemic or any such event happens, then the whole industry will be shut down. So I look for an industry which is a little bit more, day to day in demand. For example, supermarkets. And supermarkets, we can target on the mainly basic households, medicines, and all this stuff, right? And this will also help us to one of like increasing our revenue base. Secondly, this industry is more recession free and less risk as compared to the current industry which we have. And third, it will help us to gain the competitive advantage as well.
Okay. And what is the reasons?
The reason is that we wanted to go into a different segment altogether. If we stay in the same segment, then probably there is there is not much of a growth available. And the reason is that if one industry is not doing well, the other industry is going to support the parent company in making profits.
That's it.
Yeah.
Okay. Next.
I was thinking if we can go into
You
automobile
can
and
give more examples and you can talk first. We are a logistic company, then we are doing this. Make it more case study integrate. Yeah, Nikhil, please continue.
yeah, I was thinking if we can go into automobile industry. Like I forgot the exact name. I think we have something like Molton Motors already.
Yes, yes. Malton Motor is there.
Yeah, exactly. So the thing is, we are extremely dependent on our fleets for our logistic business, and at some point of time, I think we need to have some sort of control over that segment. So I think it would be sort of a related diversification, but I think it would be a challenge to raise so much of finance. I don't think we have so much of expertise either as of now.
Will be very risky. Yeah.
But yeah, it would be very risky, but I think it would be a good
And
bet
even
in
if you
the long.
focus specifically on Malton Motors, I think it's very difficult because they are
Hmm,
into, I think, how many, 40 countries or 50 countries. They look even bigger than us. There is a
exactly. So
chance
something
they can
local,
acquire us.
right? Exactly. So something local, I think would do. Also, I was thinking if we can get into some sort of a rental business on a
Warehousing
smaller scale,
services.
something like that. Yeah, which would basically ensure that our vehicles are steadily available as an how our businesses grows. We shouldn't be looking
It's like a
every
relevant
time.
or related diversification, and we are
Hmm.
already having good experience in that, and there is
Yeah,
high chances we'll be successful in that because already we provide these services to the companies only with whom we do logistics. But now we can have specifically only warehousing.
exactly. Not sure if we can get into touch with Molton Motors. As you said, it's a very big business. Um, Maybe sort of set up a strategic alliance. Not sure how would it work. Are they there in Roundland?
Yes, they are.
Like very well established, or
Yes, they are there.
it would?
Should be very well established. Then only they need support. They are our primary client.
Mhm. So if they are our primary supplier, we can sort of get into a strategic alliance with them
But why they will do with us strategic alliance?
because
And
we are.
question here is not about strategic
Hmm.
alliance. It can be just short term if we need. We are
Hmm.
looking for what kind of acquisition we can do and how it will grow.
I was just thinking, for instance, considering, for instance, India acquires lots of weapons from outside countries, right? It also takes technologies along with that. So just maybe get into a particular sort of vehicle manufacturing with them, just to begin with.
Right.
I have to think it over. I actually have to know the pre-scene for it, but something like this can be done,
Okay.
right?
Makes
And which
sense.
will be on a mutual basis. Otherwise, it wouldn't work,
Obviously.
right?
Nothing will work without mutual benefit in
Hmm.
strategic alliance, JV, and all.
Exactly. Assuming that we are a very big purchaser for them, a customer for them, Molten Motors, then I think they would be willing to do
Not customers. We are helping them with their supply chain. We are part of their supply chain. We are providing logistics to them.
that. Okay.
Yeah.
Next, Badusha.
Yeah, uh, I would do a horizontal acquisition, going into acquiring a more to get more market share in the transporting segment, because that is having the biggest chunk of money in the total logistic business in Roundland. And I think we are, if you take the total revenue to the total business, we are, I think, around just 1% market share. So I think it'll be good if we could acquire a company which is just doing transportation services, so that we can tap into a little bit more market share.
Okay.
Yeah, that's all.
That's it.
Yeah, I kind of got cut off.
You can think of, just going for a market development, going into the new country, finding a medium, small companies who are doing business like us, just acquire them, and that will be a gateway for a new economy altogether.
Yeah, true.
Okay. Shweta, anything you want to add?
I also agree with Badusha's opinion. Okay, I don't know the pre-scene in detail.
In
But
general, you can say any company.
if it's horizontal, again, they have prior experience, they have the expertise, so it's less risky and then increase market share. Especially, yeah, I can see this in page 5. They have around 58% share in transportation sector. So if they focus on expanding in that transportation sector, would be beneficial. I was also thinking these major clients like Mudox supermarkets, if they, but you said again, these are huge firms, right? Compared to.
Yes, they are very big firms.
So then
We are listed, but they are also, bigger than us or equal than us.
Mhm.
Almost. Yeah.
Right. So what would be a vertical integration in this? As an example, what would be the example of an vertical integration?
Basically, we are into service industry. Vertical here can be, we have very less amount of suppliers, but we can, for packaging materials, we must be having that kind of suppliers we can acquire. Or maybe we have fleet, right? We have fleet of vehicles. For that, we are having servicing and all of this for the garages. That thing also we can acquire. That's it.
But that would just
Nothing more.
decrease the cost, right? Not increase the income as such.
Pardon?
That would just decrease the cost, right? Maybe.
Yes. So that is
Not
also one of the
increasing.
reason for acquisition, right? We
Okay.
can do it for any reason.
Mm-hmm. And so, if they acquire customers, that would be upward integration, no? Vertical again, right?
Acquired what?
If they acquire their customers like these Murdoch supermarkets.
Their customers. So once you acquire that company, technically their customer becomes our customer.
Yeah, is that categorized as vertical or conglomerate?
It will be
Vertical.
conglomerate because they are a different industry altogether.
Okay.
This vertical, horizontal, diversification, everything is within the industry. If you go outside industry, it will be a conglomerate.
Okay.
Okay, good job. We can go forward. The reason for asking this question is just to make you think like that. Once you start thinking, no, slowly, you'll get very good points, and that will give us a perfect answer. Okay. Now, next topic is very simple. Reasons why M&A fails. Maybe you guys are aware, most of the M&A will, most means majority, more than 50% of M&A will fail. Fail as in, maybe they are successful, but they will not achieve the targets they are planned to. Then it's a compromise.
Before you continue, I just want to clear one doubt.
Yeah.
The previous question you asked, yeah, about vertical, whatever. So do we have to talk about synergy? Whatever option we choose, do we have to talk about synergy as an advantage?
Yes, synergy is mostly an advantage. You can talk about it.
Okay.
Especially when you are doing a horizontal, at that level, you're expecting a very good amount of synergy. Economies of scale, synergy, all of that. So reasons why mergers and acquisition fail, or we can say fail to achieve their desired outcome. Let's say they expected 10 million of synergy, they got only 5. So they failed by 5 millions. So they have given lack of fit syndrome. This may be due to corporate styles and all. Lack of industrial or commercial fit. Lack of goal congruence. Both the companies have different mindset. Cheap purchases. Cheap purchases. Sometimes company buys something, some companies in loss and try to convert it, but it never happened. Paying too much. Imagine we paid too much to them. Then we are not getting any synergies. We got synergies, but we have already paid them more. Overvaluation. Then failure to integrate effectively. We are not giving them time. We are not respecting the culture, the people, the product. Then also it's a problem. Especially for merger, my teacher used to say, merger example is like marriage. Both of them are coming from different families, different cultures. So definitely there will be a conflict. One person will think this is the right way. Other person will think that is the right way of doing. Maybe both are right because they are brought up in a different way. At least in acquisition, this can happen because of power they are using. But in merger, it's very difficult because both are having a power, right? Then inability to manage change. Both of them need to change. If any one of them are rigid, then also there will be a failure. Okay, they have given 7 points. Can you guys also add some point? What can be the reason of failure of M&A? Let's say Daistruk tomorrow acquire or merge with some companies. What can be the reason and how we can mitigate them? Quick answer. This is very basic. You can use the same options also given on the screen and give your option as well. Did you understood the question?
Nispa, can you
Can you
repeat? Sorry.
Wakhar, the question is, we are talking about why mergers and acquisition can fail, right? So, same thing if we relate to Daistruk. Daistruk, what are the issues that can lead us to failure in mergers and acquisition?
See,
For
the
example,
first. Yeah.
okay, I'll give first example, 1 second. First example, somebody told about Malton Motors. So one of the reason why we can fail because we don't have experience in that. Simple. Yeah, continue.
I think,
Cultural mismatch.
yeah.
Wakhar, continue.
Yeah. I was about to say the same thing. Cultural mismatch. Maybe we think the company we are going to go is like similar to us, but in reality, there is a big cultural mismatch. There's a difference in the policies. Plus, the first thing is that when we do the valuation of the company, the cost of acquiring that company turns out to be very high, which is not affordable for us. Or a management perception, because management perception could be different, that rather than acquiring a new company, we should acquire different business, right? So these all kind of things can play into role.
Yes. Next. Anybody else want to add? Hello.
Yeah, we can hear you.
Okay, we'll move forward. Next is the sources of synergy. Synergies can be coming from lot of different areas, but obviously we need to plan in advance. And when we do M&A also, we need to be careful and taking it out. It's not like automatically it will come. So if we talk about operating economies, it can come from economies of scale, complementary resources, vertical integration. If we have done, it will help us for the commission. Elimination of inefficiency. If something is not efficient, we can, for example, laid off the employees. Okay. Then sources of synergy from financial perspective can be diversification in financing, bootstrap or PE game. So basically, PE is used to value a business valuation. If PE is higher, then business valuation can be increased. Diversification for our revenues can also happen. Other synergetic benefit can be you have surplus manager talent, can be used for different purposes. Market power, we can increase. Surplus cash, we might have. Speed of working options. These are normal. Not necessarily we can get all of this. Some M&A will get some synergies, another M&A will get other synergies. Next is tax implications. Difference in tax rates and double tax rates is also a problem with the lot of companies. So they want to go in countries where there are low taxes. For example, in 2018, Amazon paid $0 federal tax. It was a very big news. Next year, due to reputation, they started paying off. Why? Because they want to pay in Europe. They want to pay in other countries like Switzerland, Ireland, where they are considered as tax havens, where they have very low tax. But we have a session of OECD. They are saying, we should not charge them very high. There should be no double taxation. Legally, we have to get withholding tax. This is all technical. Then competition authorities are important. I was just saying in the start, what competition authority wants is ultimately the customer should win. They want to strengthen the competition. They want to prevent or reduce anti-competitive activities. Public interest should be done. So they say anything which has more than 25% market share, is a kind of anti-competitive. It's kind of leading to monopoly. And sometimes if it is related to national security, for example, food suppliers, they need for local, they need for any other type of security also, they can block certain businesses. Media quality, financial stability, there can be a lot of reasons. It's a government run, right? So they are having a lot of power. It's a very powerful stakeholder. Sometimes they investigate so much, the time is very high, and the M&A, they will just change the plan because businesses are not ready to wait that long. Next is divestment. Divestment is just opposite to acquisition. We are selling some part of the business. Why we are selling? Maybe it is not giving us a good return, or it is very less profitable. It is unwanted for us. We have changed our business strategy. We are focusing on new things, let's say more on technology. So we want to get rid of physical work. That is divestment. So that can be done to a third party also. Sell off, trade sale. And we have another thing, spin-off, also known as demerging. If it is a very big company and you have different operations, you want to demerge it, this can be a strategy to show the market the real value of the business. Or sometimes we do it to avoid if there is an acquisition against us, like somebody is coming to acquire our company, Daistruk. So that time we can use it to make it separate. It's just opposite of mergers. Management buyout. When companies are doing divestment, they can think of, instead of selling outside, why can't we do it to the current management who is already taking care of the business? So they will try to sell them off. But the problem is the amount of money it requires. Usually these employees will not have that much money. So they have to work like a startup. They need to go to venture capitalists, they need to go to banks, they need to go to other financial institutions and see if they can get the money. They can give collateral, they can give equity of the company in exchange of that. Okay. Consideration will be current owner wish to sell, potential of the business, loss of head office support. This management team, can they work without the head office support? Do they actually have the quality of working on it own? Price. Can they afford this price? Usually they're expecting a good discount from the company compared to market rates. So same, they will do the financing like any other startups, borrowing, senior debt, junior debt, all of it. What is the main risk? The bid price offered by MBO team might be too high. Lack of experience in key areas, especially finance management, very important. Loss of key staff who either perceive the buyout is too risky or do not have capital to invest. Maybe every member of the team, management team, is not ready to go forward with it. And especially if it is a service industry, then that person is very important. Lack of finance is very big reason. And maybe the employees also within the department will start leaving. Why? Because they don't trust that this can survive. Exit strategy for MBO is very simple and very similar to startup only. They can trade sell, they can sell it to other companies. If it becomes very big, they can go for listing, IPO, initial public offering, where they can sell and raise money from the public. Last one is independent sale. What they will do, they themselves will make it a private company and buy off all the venture capitalists, give away the loan and everything, take everything in our control. Why this is important for us to know? This is just a knowledge. If you tomorrow want to do a management buyout, I need to explain the managers that we are making you redundant, but we are giving you option that you can buy off that business, so you don't become jobless. That's the only way. Very, very real probability. Especially in our case, this time we don't see anything that can be done as a divestment. In fact, we need to grow. Next is valuation of the business. This is very important. Mostly this is calculation based. Okay. For example, Daistruk is buying certain company. We cannot just agree whatever price they say. Will you agree? No. You'll do your due diligence. If it is listed company, it's easy to value them because there's a number of shares divided by value of shares. That's it. I know one real example. One of my friend companies, company in Middle East, they want to sell it off. They quoted some price. Then the party was interested to buy. They are like, okay with the price, but we'll do due diligence. So they went to KPMG, one of the big fours. Later on, it realized that the price they quoted is 10 times more than what they deserve. So obviously that deal got cancelled. Imagine if they have paid that without due diligence. There will be no synergy. There will be loss. Why? Because they are paying too much. So due diligence is very, very important because every company want to show the higher and higher valuation. But do you agree with it? Technically, there is no legal requirement. If the buyer and seller is happy, they can buy and sell at any price. However, coming to something sensible, we have to see some of the methods of valuing a business. For example, reported sales and profit is one. Forecast sales, some of the business, for example, I was reading on when LinkedIn started in the initial stage, that time lot of newspapers were having multiple types of revenue in the US, but still LinkedIn, and being a social media platform, it got very big valuation. Why? Because of the forecasted sales. In the future it will grow, but the printing industry was going down. So a lot of time you will see the revenue or sales now is very less, but of the future potential it will get very high valuation. So it also depends on which kind of industry it is. Is that industry growing or not? For example, now edtech industry is growing, fintech is growing, education and technology, finance and technology. Types of industry, level of competition, what they have. If it is very competitive market, a lot of people don't want to go and buy and come into that. Why? It's already saturated. Range of products they are selling, how diversified the business is, breadth of customer base. If the breadth of customer is good, they can even cross-sell them different products because already trust has been created. Perspective, at the end, everything is about perspective. What they feel like. Sometimes it is done only to get the licenses, as I gave you the Heathrow Airport example. Okay. Is there anything we are missing that can affect the value of business? Hello? There may be some points.
Reputation.
Reputation, yes. Intangible value also we can say.
Human capital.
Human capital. Reputation, I want to share one story. In India, I think it's almost 30 years before, there was one very big incident happened. It's known as Bhopal gas tragedy. Okay. So that company and everybody left. They didn't pay any compensation and everything. They went out of the country, and that time rules were also not that strict. Somehow they went over and a lot of people died in that incident. Now, after so many years, in 2012 Olympics, one of the pharmaceutical company acquired that company. Just a small, they are a very big company. They acquired this company and they were one of the sponsors there. So people said that this company acquired the company which is having a very bad track record. That means they also have the similar mindset. They are unethical. So they started to boycott it and they didn't get the sponsorship title also. So you can imagine if we just acquire a company which has bad reputation, that means we are also a part of it or we are also alike. So we need to be very, very clear with whom we are associating with. What is their background? What they have, decisions they have taken in the past. Because their reputation becomes ours. Their good reputation also, bad reputation also. Same thing goes with the project. Yeah. Waqar, you are saying something.
No, I was referring to the human capital and definitely the goodwill or reputation which one of the guys said. So these things also are important, I guess,
Yes.
because it's not just about the employees. One company might have hired people, there are experienced people, they know the industry, they have been already working for them for like long time, and then when you come and acquire it, so definitely these things will matter. It also includes the management, mid-level management and high-level management, so that should also be a part of the business valuation.
Right. Debt is also a very big factor in valuing the business. Valuing business or being transaction, sometimes debt cannot be transferred, and that company doesn't have enough money to pay off the debt, or the covenants are very strict. Okay. What else? Logic points you can give. Just imagine you're buying something. What will affect its value? Even you can see how long they are operating in the business, what level of experience they have. Can we trust their data? Right? Anything else? Okay, we can go forward. So now we have key terminologies here. Listed companies, unlisted companies. As I said, listed companies are very easy to acquire. We can even take a majority of the shareholdings, shares of that. Unlisted companies, little bit difficult to value the business. So what we do is we want to value a unlisted company. We take a similar listed company and just uh, reduce it by 25 to 30%. Why? Because lack of marketability of the shares. Levels of scrutiny is low. Higher risk of being small, less will regard company like this. Let's say unlisted company you valued at 50 million. So you'll reduce by 25%. 35, 37 you'll value. Valuation methods. How to value the business. First is asset-based valuation. Very simple. You add up all the asset the business has, become asset-based valuation. Like in our case, our fleet, our warehouses, our office buildings, and maybe whatever assets we have, that become asset-based. However, the problem is here we are not taking care of intangibles. So in order to compensate, there is another option, that is CIV, calculated intangible value. What it says is whatever we are getting returns based on an asset plus the industry average. So if you are getting more than industry average on the same asset, maybe because of the intangible. So this is how they try to use this or cover up the weakness of asset-based valuation. However, asset-based valuation is very, very rarely used. This method is used primarily when you are closing the business, when you don't want to continue. So whatever asset you have, just value it based on the second-hand market and you sell it off. Strength, the valuations are readily available. They provide minimum value of the entity. Weakness, we don't even think of future profitability, even if you're using the intangibles. Financial position, accounting conventions, what standards they are using, it will get affected. And very difficult to come up with the intangibles. Second method is earning based method. What is earning based? So here mostly we are looking at the current earning, the future earning, all of that. So what we say here, value of any company is total post-tax earning equal to PE ratio. Remember, P is one of the reason why acquire business. Same thing. Price earning ratio. Whatever is the net profit multiplied by P ratio, because we assume that the same level of growth will happen to the business. What is the strength of this method? It is very commonly used. If you say for Daistruk also, which kind of method is very good? So we'll say earning, because we have a very sustainable earning. It looks at the future profit. Relevant for valuing or controlling interest. Weakness based on accounting profit rather than cash flows. Very difficult to come up with suitable. Why? Because some companies will acquire another company or use some shortcuts or loopholes to come up with a higher PE. Though we are assuming, but can we guarantee we'll have a sustainable level of earnings? No. Okay. Next is earning yield method. This is a part of this only, very similar. Total earnings divided by earning yield. So we are assuming yield is the return. How much returns we are getting based on that. Next is dividend valuation model. So the value of the company is present value of the expected future dividend. So we are assuming that if we pay same level of dividend, based on that, how much is the valuation of the business. But it also has certain weaknesses. It believes that let's say you are paying 40% of the dividend, so it will assume 60% you are investing into the business. However, we don't only invest 60%. We can pay 40% of the dividend and we can take loan of 40%, whatever you paid. Let's say we paid 4 million dividend. We can take a loan of 4 million. So that is a problem with this. So this can be used, but again, there is a very big weakness. Why? Because it assumes that we don't have a loan option. We don't have a debt option. Only retained earning is considered as investment, which is not true. And it's not necessary every year we are investing also. So basically, when you talk about future, it's all assumption. Nothing is like permanent or guaranteed. What is the strength of using this? Based on the present value, useful for valuing minority shareholdings. Weakness, very difficult to forecast dividend growth. Special for unlisted companies because they don't pay dividends at all. Jitu, you said something?
ഉണ്ടോ? ഞാൻ ചോദിക്കാം എവിടെ?
Yeah. Okay. Now next one is discounted cash flow. You remember what was the weakness here in earning base? It just work on profit. And you know, companies can show profit, but they didn't have still cash. So cash flow is important. Cash is king, right? So very similar method, but only thing is we are using cash flows. What is the logic here? The value of the equity of the entity is derived by the estimating the future annual after-tax cash flows of the entity and discounting this cash flow as appropriate cost of capital. So here, this is also the best method of valuing because we are taking actual cash flow and we are even discounting at the cost of capital. What is the strength here? Theoretically, this is the best method. It can be even used to place maximum value to the entity, and it is considering the time value of money. Why? Because we are discounting it. Weakness, same weakness. Whenever it talk about future, difficult to forecast. Difficult to come up with different discount rate also. And after that period, how you will value the business. Basic NPV method does not evaluate further options that next. NPV is like net present value. Okay. So basically what you need to know for you need to understand the types of business valuation options we have and what are the strengths and weaknesses of all of this. For example, asset based valuation, not very suitable for service based. Earning base is good, but doesn't consider the cash factors of it. Very difficult to forecast the future. Dividend valuation is good, it take care of the dividend and everybody, but the problem is everything. But the problem is it doesn't understand or consider the debt factor. Debt can also be a source of investment. So discounting cash flow is good, and again, thing is very difficult to come up with the cost of capital. However, given a choice, the two best option is discounted cash flow and earning based valuation. It is good for asset base also, and manufacturing company with very high asset and service company also with low assets. However, if you see at our company in Daistruk, we have good asset also, and we have service industry also. with a very good intelligence. So please remember this. Sometimes they'll ask a very simple question: what are the types of valuation method we have? And you have to recommend one of them. They're saying this cash flow to equity, cash flow to investor, how it is calculated. This is more of calculation, not required for us. CAPM, again, it's a calculation, but quickly we can understand unsystematic and systematic. Unsystematic risk is the risk of the company's cash flow being affected by specific factors like R&D, success, system failures. So any company has two type of risk. One is systematic, one is unsystematic. Unsystematic risk is which is internal to the business. Let's say for Daistruk, we have problem with our employees. We have problem with the R&Ds. We have problem with our operations. We have problem with our data. It becomes unsystematic risk. And systematic risk is mostly external. Government is changing laws tomorrow, right? There is an economic downturn in Roundland. Can we do anything? No. Assume in an ideal situation, maximum what we can do is we can reduce unsystematic risk, which is internal. But can we do anything for the market external? No. That's what this diagram is saying. Okay. That's what the beta factors come in. When beta is more than 1, we can say we have more systematic risk. Same means equal to 1 means same systematic risk. More than 1, sorry, more than 1 means less than 1 means more systematic. If beta is less than 1, beta is equal to 0 means there we have no risk. What is R beta? Greater than 1 or less than 1?
It's greater than
1.27. 1.27.
1 point
I think 27.
27. So we are 27% more riskier than the stock market average. Okay. Why we are calculating here? Because in business valuation, when you do calculation, we have to show the risk. Why risk? Because when customers, the shareholders are accepting 27% more risk, they'll accept more return. They'll be expecting more return. Therefore, we do that. Then it's all calculation and criticism to that. This is again calculation. Here they are talking about how to value the equity beta, debt beta, and all of this. Not very important for the case study. However, if you want to just do for the learning, you go through it. We can discuss it separate. Not important for the case studies. Okay. We have efficient market hypothesis. This terminologies maybe you are aware already. So what it says is the market value. You know, you are a listed company. Okay. So share price will determine the value. We live in which market? We live in semi-stock. Whatever goes in the market, whatever information is publicly available, share price will react to it. That is semi-stock. However, in the past, or sometimes, it's very rare, but weak form efficiency is like things are available in the market, informations are available, but still people don't trust it. They don't care. We'll just see the past trend. If there is something in the newspaper today, share price won't react to it. That is weak form. Another form is strong form, which is unethical and illegal. Insider things are being carried out. Let's say directors are going and disclosing the things. Daistruk is acquiring another company tomorrow, and it will give them some more profit. So because of that, your share price is going up. Okay. This thing can happen. How it will impact the business? Let's say somebody hacked our system and we are not ready to pay them. As ethical responsibility, we have to disclose. When you disclose, automatically the share price will go down, at least for smaller time. So that person or that group may be ready with the money. They want to just buy a lot of shares, and when it reaches normal, they want to sell it off. So different strategies they can use. We have to be very careful. If they ask a share price related question, so you can say we live in a semi-strong market. So whatever is happening in the market and whatever information is publicly available, definitely it will affect our share price. However, in the long term, if this is just a rumor or a wrong information, the fundamentals will take the role. Or fundamentals are important. If fundamentals are strong, our company is strong, definitely share price will be back to normal. All right. Any confusion?
No.
Yeah. Now we have a last chapter. We'll quickly finish it. Now this is post-transaction issues or pricing issues. Basically, in this chapter, we are looking at, let's say, mergers and acquisition happened already. Chapter 11 was about why to do mergers and acquisition. 12 is about how to value it. Now 13 is looking at post issues in a reactive way. Okay, when the bid has already been taken, or let's say acquisition or mergers already happened, that issues they are looking at. So first, they are talking about a scenario. Defense against hostile takeover bid. Let's say one of our stakeholder, that is Malton Motors or Murdoch's. Murdoch's want to acquire us, and obviously we don't want to sell. So what options we have? Pre-bid and post-bid. Pre-bid is, that means you are just assuming this can happen. But post-bid is like already you got an offer. So pre-bid we have an option is communicate effectively to the shareholders. Please don't sell the shares. Even if they are giving you multiple times the value, don't give it. Give them more information. Second is revalue non-current asset. So what will happen with the revalue? Automatically the valuation of the business will go up. Third is poison pill. Poison pill is, let's say they are acquiring us because we have a lot of cash surplus. So just give that as one of dividend or buy another companies. Do something. Look less attractive. Next is supermajority. Change some regulations and all. Let's say higher percentage. So even if more than 50% people are ready to sell, it's not doable. Next situation is even difficult. Let's say already they got the offer. So again, you go to the owners, to shareholders. Please don't do that. That thing is not worth it. Second part is related to that, attack the bidder. This company is unethical. Because of that, you won't get dividend. People will lose job. Something like that. Third is white knight strategy. This is a little bit unethical, but communicating that company, why are you acquiring us? Why don't you acquire our competitor? Will help you or somebody else. Just leave us out of this. The tactic basically. Last one is very aggressive. How can you buy us? I'll buy you. I have a lot of money. I'll arrange the money, which is very rare, especially if the other company is very good. Last option is, if you feel like this is unethical, illegal, you go to the government, competition authority. Say this will create a monopoly. Why this thing is going forward? We should not support this. So government can also come in and stop this. This has never been asked so far in the exam. This is for the knowledge. Yeah, this thing is important for us. The forms of consideration of takeover. Let's say now Daistruk is acquiring a company. So how will pay them? You have two options. One is cash. Second is share for share exchange. Third is earn-out. Earn-out can be in cash also and share for share exchange also. But cash is mostly used for small acquisition. Because if you are doing a very big acquisition, it's very difficult for you to arrange so much cash. Then you have to take a loan or you have to do rights issue. However, it will have certain advantage and disadvantage. For example, if you go for cash, it's very quick, less risk, increased liquidity to shareholders. Disadvantage, I'm talking from Daistruk perspective. If we do that, for us, arranging money, we have to usually borrow it. Then second is, lot of target shareholders may not be happy. Why? Because they will lose away the ownership. And you can imagine the taxable amount they have to pay. Now we go to share exchange. What is the advantage? You don't need to pay anything. And most of the time, the bigger acquisition happens with the share for share exchange. Second is, company can bootstrap EPS with a higher PE. You can still increase the value of the business. shareholder capital is overall increase. But what is the disadvantage? The current company shareholders might not be happy to have new owners coming in. You don't want to share the earnings. Second is price risk. The price is can be high. You'll not get cash discount here. Third is integration issues. We can talk about a lot of other disadvantages also. Now you have to change a little bit because their shareholders are coming, so their mindset, their culture, their way of working will be okay. Any other disadvantage can you think of in cash and share for share exchange? Or what do you think will be better for Daistruk? Is it share for share exchange or cash? Apart from the points given there.
Share exchange.
Sorry?
Share exchange.
Share exchange, okay. Why?
So Daistruk won't go for acquiring a small company. So they will always target a medium or large size company. So
Right. And currently, if you see the financials, we don't have good amount of cash also available.
yes.
We have to raise it. It will take time. And it will affect our gearing. So a lot of things we need to consider. However, if they ask you in exam, don't just jump directly to share. Talk about cash, advantage, disadvantage, share, advantage, disadvantage, then recommend share mostly. Okay.
Okay.
Third option is earn-out. Earn-out is similar to that. Only thing is in earn-out, you are saying if you are acquiring a company, let's say just for their managers, and imagine their managers only retired from the company. They are saying we want to leave, or they are not putting their efforts. So what companies do? They'll say, okay, we'll pay 50% now, 50% we'll pay later, but that is conditions apply. If you do good job, if you perform better, then only will. So we'll have a financial risk that is passed on to the sellers. This is very important when we are acquiring business, especially service business, which has a key employees. Their commitment is very, very important. Okay. Limitations to this. Usually it works best when they have some plan. In vision, you have done a business plan or anything. But the problem here is sometimes the buyer can block the earn-out targets unethically. Therefore, a lot of people won't agree for earn-out. They say just give it now because you cannot trust them for the future. Now, what is the total value of the business? Your current value, your value of a victim company, what you have done, or target company, we can say, and any scenario. This will become a total value of the company. Shares also is similar. Your shares, their shares, total value. Bootstrapping and post-acquisition values is like basically we use a P and show a better valuation. It's more of calculation. No need to worry. Yeah, this is important. Just last 10 minutes. Okay. There is one guy, Durkheim. This is a very big management guru kind of thing. This guy from Harvard and written a lot of books. This is saying when we are going for mergers and acquisition, we need to take care of 5 golden rules. If you do that, it will be successful. It can be successful. First is within 1 year, you should provide skilled top management for the acquired company. Basically, you give them the skills. Second is we should not be selfish. What synergy we are getting from them and just making people redundant. We should also think what we can do for them, what we can offer them. Okay. Third is we should respect. This is very common. Respect their products, respect their culture, respect their market, respect their customers, and respect their way of working. Next is Now after M&A, we are one. So there should be no internal politics. There should be no, dealing them differently, their employees differently. We should all work as one, core of unit. Last one is we should do a lot of cross entity promotions, so people get used, and there should be a sense of oneness. Goal congruence should be there. All of this should be done in 1 year, within the first year, because people can have patience in the start. There are a lot of other things we can go on, but this is something which is more respect. And whenever we are acquiring another company, all these strategies should be before in place. We cannot say after acquiring or after merging, we'll have a strategy. No, everything should be before in place. We should see cost cutting, synergies, everything in advance. You can see if there is any redundancies coming in, how you'll manage. Especially if it has union, you can imagine how much big hassle it will be. How you can reduce the cost of capital, how can you reevaluate, how you can make a positive way to communication. Sometimes even if you're not making redundancies, no, employees will be afraid and they'll themselves start resigning from the job. So we should prevent demotion and always try to see what economies of scale we can bring in, especially if it is vertical, horizontal. We can review the assets. There may be need to pursue more aggressive marketing, especially if you go for horizontal, same company, you have to do more marketing, very aggressive. Risk of acquisition need to be real. Risk, what if we fail? What can happen in the worst case scenario? And most important is objectives. We cannot just put our objectives every time. We have to be having harmonization of corporate objectives. Okay. These are some of the things which can reduce the post-acquisition issues or post-merger issues. Yeah, that's it from this chapter. Any questions, any confusion?